They told you the United States was built by revolutionaries, farmers, inventors, people with grit, courage, and ideals. But that's only half the story. The real takeover didn't happen with muskets or ballots. It happened with ledgers. A quiet coup, one waged in marble halls, signed with fountain pens and sealed in vaults. This wasn't a battle for land. It was a battle for credit. And the day money won, democracy quietly changed hands. Before we start, if you're passionate about understanding the hidden forces behind power and wealth, hit that subscribe button. It keeps us digging deeper into stories most people never hear. Also, tell me in the comments, where are you watching from? And what time is it right now in your country? I love seeing how global this conversation has become. All right, back to the story. America IS founders feared one thing more than standing armies: private bankers controlling the nation's credit. Jefferson warned that if banks ever gained that power, they would strip citizens of property until their children wake up homeless. For a time, the Republic listened. It kept banks small, state-chartered, and limited. But ambition always finds a crack. By the early 19th century, paper money was spreading faster than gold could back it. Local banks printed notes, lent wildly, and often collapsed. Panics came and went. 1819, 1837, 1857. Each crisis pushed more control toward those with capital. The government tried centralization twice, the first and second banks of the United States, but populists crushed them both. For nearly 80 years, America had no central bank, and yet bankers grew stronger. The Civil War changed everything. To fund it, Lincoln issued greenbacks, paper notes not backed by gold. They worked. The Union won, but bankers hated them. Debt meant control, and government issued currency bypassed private lenders. After the war, they lobbied hard to destroy greenbacks and restore gold-backed bonds. By 1879, they succeeded. Credit shrank. Farmers and laborers paid the price. For Wall Street, discipline meant opportunity. By 1900, New York was the world's second financial capital. Railroads, steel, oil, all ran on credit controlled by a few houses. Morgan, Kuhn, Loeb, Rockefeller's network of trusts. Every boom and bust widened their reach. But one panic changed the rules forever. In 1907, a speculative bubble burst. Trust companies, proto-investment banks, started collapsing. There was no central bank to rescue them. In stepped one man, J.P. Morgan. He locked New York's top financiers inside his library, ordered them to pledge assets, and personally decided who lived and who failed. Overnight, a private citizen ran America's financial system. The message was clear. The government might print money, but Morgan made it move. This moment terrified Congress. It proved the nation was dependent on bankers to avert collapse. But instead of breaking that power, Washington joined it. Behind closed doors, they drafted a plan to formalize the system, to make the next rescue legal. It began not in D.C., but on a remote island off the coast of Georgia, Jekyll Island, November 1910. A handful of bankers and one senator boarded a private rail car under fake names. Their goal, design a central bank owned by private institutions, but backed by public guarantees. The result would be a Federal Reserve, a network of regional banks governed by a central board, public in name, private in structure. When Congress passed the Federal Reserve Act in 1913, few understood it. The timing was perfect. Within a year, war in Europe exploded. The U.S. would soon need a mechanism to issue credit on a scale never seen before. For the first time, America could finance global conflict not with gold, but with promises. The Fed's creation marked the true turning point. It separated money from metal, tied credit to policy, and made the banking sector the silent partner of the state. Politicians could spend, bankers could lend, taxpayers would pay later. From this point on, economic crises no longer reset the system. They deepened it. Each bust became justification for greater intervention. The more markets stumbled, the more Washington leaned on the Fed. And each intervention funneled more power upward. The day money won wasn't a single headline. It was this, the institutional handoff between democracy and finance. To understand how deep this goes, we need to trace what came next. How the Federal Reserve turned credit into power, and how that power redefined freedom itself. The First World War became the Federal Reserve's first true test. For the first time in history, America could wage war without emptying its treasury. Instead of raising gold or direct taxes, it sold bonds to its own citizens. Millions bought them, believing they were helping the nation. In truth, they were funding a new kind of system, one where wars were fought on borrowed money. This shift changed everything. By the time the war ended, America had transformed from a debtor to the world's biggest creditor. Europe owed billions, and the interest payments flowed to Wall Street. Credit became America's most profitable export. But after the victory came a question no one could answer. What happens when debt becomes the main product? The 1920s gave a glimpse. Cheap credit-fueled speculation, stocks soared, factories expanded, people bought cars, homes, radios, often on installment plans. The illusion of prosperity hid the truth. The system had become addicted to leverage. When confidence cracked in 1929, the entire pyramid fell. Banks failed, depositors lost everything, and again, Washington turned to bankers for help. Franklin Roosevelt entered office promising to rescue the people, but the real rescue came for the system itself. In 1933, he took the nation off the gold standard domestically. Citizens could no longer exchange dollars for metal. Their money was now backed only by trust in government, and behind that trust stood the Federal Reserve. Gold moved from private hands to federal vaults, consolidating control. This was a crucial turning point. The Fed now had the freedom to create money at will. Every crisis since has followed the same script. Credit expands, bubbles form, the market collapses, and the Fed steps in with more liquidity. Each round makes the economy more dependent on intervention, and each intervention deepens the bond between the state and private finance. By the end of World War II, America was the undisputed financial center of the planet. The dollar became the world's reserve currency. Under the 1944 Bretton Woods Agreement, other nations pegged their currencies to the dollar, and the dollar was tied to gold. But this system carried a flaw. The U.S. could print dollars faster than it could mine gold. For decades, foreign governments quietly redeemed their reserves, draining America's stockpile. By 1971, Nixon ended convertibility. The dollar was now a pure fiat currency, money created from policy, not metal. That decision completed what began in 1913. Money had broken free from all physical anchors. Its value now depended on confidence, interest rates, and central bank control. And that control was exercised not through laws or votes, but through the flow of credit. From that moment, the game was clear. Whoever controlled debt controlled destiny. In the decades that followed, every major economic boom, from housing to tech to global trade, was financed by this invisible mechanism. The Federal Reserve set the tone. When rates fell, markets soared. When rates rose, recessions hit. What was once a marketplace became a managed environment. Politicians learned the pattern. If growth slowed, they demanded stimulus. If unemployment rose, they asked for cuts. Each request forced the Fed to act, often expanding its balance sheet, effectively printing money to buy debt. Over time, the government borrowed more than it taxed. Private corporations followed suit, using cheap credit to buy back shares and inflate prices. Households joined in, financing lifestyles through mortgages and credit cards. The entire system became one giant feedback loop of debt. The irony is that this arrangement feels stable until it's not. The same structure that sustains prosperity also magnifies every downturn. The more debt there is, the more fragile confidence becomes. When liquidity tightens, everything stops moving. To prevent collapse, the Fed steps in again, promising liquidity. The system breathes, but each rescue grows larger. In 2008, the pattern reached a breaking point. Decades of deregulation and speculative lending crashed into reality. Mortgage-backed securities failed. Lehman Brothers collapsed. For a moment, global credit froze. This was supposed to be the system's self-correction. Instead, it became the largest bailout in history. The Fed cut rates to zero, injected trillions, and began buying assets directly. The message was simple. Markets would never be allowed to fail again. This was not capitalism. It was credit management, a hybrid of public promises and private risk. The Fed had become not just a lender of last resort, but the ultimate market maker. Every decision, from bond yields to housing prices, now depended on its policies. The victory of money was complete. What began as a tool to stabilize finance had become the engine of governance. Elected officials could change rhetoric, but not the rules. Real power sat in a boardroom of unelected technocrats. When they spoke, markets moved. When they hesitated, nations trembled. But something deeper shifted too. Once upon a time, wealth came from production, from creating goods, services, and value. Today, wealth comes from access to credit. Those closest to the source, major banks, hedge funds, governments, benefit first. Everyone else follows downstream, paying higher prices with devalued money. The structure ensures inequality grows. It's not by accident. It's by design. The day banks took over wasn't marked by tanks or riots. It happened through laws, charters, and quiet crises. With each cycle, the public lost a little more autonomy. And yet, few noticed. Because as long as markets rise, as long as jobs exist, and as long as dollars still buy something, most people never ask who controls the tap. The truth is that every modern boom, every national budget, every promise of growth rests on borrowed time. The question now is, what happens when the borrowing stops working? Every empire believes it can manage its money better than the last. Rome clipped its coins, Spain flooded Europe with silver, Britain built its empire on paper promises backed by gold. The United States went further. It built an empire on debt. And for over a century, the system worked because people believed in the dollar. But belief has limits. After 2008, the Federal Reserve didn't just rescue banks, it rewrote the playbook. Through quantitative easing, it began buying massive amounts of government bonds and mortgage securities. This wasn't temporary support. It was structural intervention. The Fed became both the buyer and the insurer of last resort. The more it bought, the more markets rallied. Investors learned the lesson. Risk no longer mattered. The central bank would always be there. That guarantee had consequences. Debt exploded. Government borrowing surged. Corporate leverage soared. Even households joined in, confident that low rates would last forever. Trillions in new money entered circulation, but production didn't match it. The result was inflation. Delayed, but inevitable. When prices began rising in the early 2020s, policymakers blamed supply chains and energy shocks. But the real cause was deeper. Too much money chasing too few goods. This brings us to the heart of the story. When money stopped being tied to anything real, power shifted from producers to issuers. The Federal Reserve doesn't manufacture wealth. It manufactures liquidity. But that liquidity decides everything, from home affordability to stock valuations. You feel it every day, even if you don't see it. When your rent rises faster than your salary, when savings earn less than inflation, when asset owners get richer while workers fall behind, that's the bond trick at work. In this system, the government borrows endlessly, and the Fed buys that debt. New money enters through financial markets, not through wages. The first recipients, banks, funds, corporations, use it to buy assets. Those assets appreciate, creating the illusion of growth. But for ordinary people, the effect is reversed. Prices rise faster than pay. Debt becomes the only way to keep up. The ladder of opportunity tilts toward those already holding capital. You might think elections or policies could reverse this, but they can't, because every administration, regardless of party, runs on deficits. Every promise, from healthcare to defense to infrastructure, depends on borrowed money. And every new borrowing cycle strengthens the same loop. Government issues debt, the Fed supports it, and Wall Street profits. There's another layer few discuss. The US dollar isn't just national currency, it's the world's primary reserve. Foreign governments, corporations, and investors hold trillions in dollar-denominated assets. This global demand creates an illusion of infinite borrowing power. But it also means the world's prosperity depends on America's willingness to issue debt. When the Fed tightens, emerging markets suffer. When it eases, speculative bubbles form everywhere. In either case, control flows from Washington and New York. Some call this financial imperialism. Instead of armies, it uses interest rates. Instead of colonies, it builds credit dependencies. When a developing nation borrows in dollars, it ties its fate to the Fed. A small policy shift in the US can crash currencies thousands of miles away. That's not coincidence, that's design. Money is no longer a domestic tool, it's a geopolitical weapon. Consider what happens during a crisis. The 2020 pandemic shut down economies overnight. Markets panicked. Within weeks, the Federal Reserve injected trillions, slashed rates, and began buying corporate bonds. The message was clear. Every downturn would be met with liquidity. Stock markets soared even as businesses closed. Wealth concentrated at the top. The line between public rescue and private enrichment blurred completely. You might ask, why doesn't anyone stop it? The answer lies in dependency. The modern economy cannot function without constant credit expansion. Every loan creates deposits. Every deposit fuels spending. If the system stops growing, it collapses. That's why interest rates rarely stay high. That's why every crash is met with new stimulus. Once a nation builds prosperity on debt, the exit disappears. This is what makes the day banks took over invisible. It wasn't one event, it was a series of quiet decisions, each justified, each rational, each pushing the boundary a little further. A bailout here, a rate cut there, another round of bond purchases. The effect compounded over generations. What began as a support mechanism turned into a governing principle. Today, even the language of policy reflects this shift. Growth is measured in GDP, which rises with spending, even if the spending is borrowed. Success is judged by market performance, not household security. And every downturn is treated as a threat to national stability. The system now serves itself first because its collapse would drag everyone else down. You see the results in wealth distribution. The top 1% own most financial assets. Their fortunes rise with every stimulus. The middle class, holding mostly cash and debt, absorbs inflation. The poor, priced out of assets entirely, bear the highest cost. This isn't failure, it's architecture. The closer you are to the money source, the more you gain. The further you are, the more you pay. The irony is that most citizens believe they live in a capitalist democracy. But capitalism rewards risk and innovation. What we have now rewards access and scale. Small businesses compete in markets distorted by cheap credit. Savers are punished for prudence. Speculators are rewarded for leverage. The game's rules were rewritten long ago, and the referee became a player. When you step back, the pattern is clear. Each century, money grows less tangible but more powerful. Gold became paper. Paper became data. Today, your wealth is a number stored in a digital ledger managed by private networks and public authorities. That number's value depends entirely on the same confidence loop created over 100 years ago. The question is, how long can a system built on belief sustain itself? And what happens when that belief begins to crack? The illusion of control is the final stage of financial dominance. Every empire that masters money believes it can steer the future through policy. But no one truly controls credit. It grows faster than anyone plans and spreads wider than anyone predicts. The same mechanism that built prosperity eventually breeds instability. That is the paradox of modern finance. The very tools designed to prevent collapse now make it inevitable. Look at the cycle today. The U.S. debt has surpassed $34 trillion. Interest payments alone exceed defense spending. To pay those bills, the government issues more bonds. The Federal Reserve buys a portion of them, either directly or indirectly, adding new money into circulation. Investors, seeing the Fed's support, rush back into markets. Prices rise, confidence returns. But underneath, the debt keeps growing. This loop depends entirely on one fragile condition: faith. As long as investors believe the government can pay, the system holds. But confidence is not infinite. Every time inflation spikes, every time deficits rise, every time political gridlock delays action, that faith erodes a little. And when faith weakens, the cost of borrowing climbs. The higher the cost, the faster the debt grows. Eventually, the circle tightens. You've seen signs already. In recent years, the Fed tried to unwind its balance sheet, raising rates to fight inflation. Markets stumbled. Yields spiked. Regional banks failed. Within months, policymakers reversed course. They couldn't allow the system to self-correct, because self-correction now means collapse. That's the clearest proof of who truly runs the economy. The banks that once served business now serve policy. They channel credit where incentives point, into financial assets, not production. Every dollar loaned into speculation creates no new value, only higher valuations. And every bubble needs a rescue. When the rescue comes, the pattern repeats. More liquidity, more debt, more dependency. The structure feeds itself. Some argue technology will fix it, that innovation or digital currency will stabilize the cycle. But technology doesn't change incentives. It only amplifies them. A central bank digital currency, for example, could make monetary policy faster and more precise. It could also make surveillance easier and capital controls absolute. The line between convenience and control blurs quickly when every transaction passes through one gatekeeper. The deeper problem is philosophical. Money used to represent work and production. Now it represents claims on future growth. Those claims keep expanding even when real productivity stalls. The disconnect grows wider each year. You can see it in asset markets detached from wages, in corporate valuations divorced from profits, in national budgets built on projected tax receipts that may never arrive. The numbers rise, but the foundation thins. And yet, despite all of this, life goes on. Stores stay open, markets trade, jobs return. That's the brilliance of the bond trick. It converts complexity into routine. You don't need to understand it to participate. You only need to keep spending, borrowing, and trusting. As long as everyone plays along, the illusion holds. But history suggests illusions don't last forever. When money loses its anchor, societies eventually look for something real: land, resources, labor, stability. The last time global finance reached this scale was before World War I, when gold-backed empires funded growth through credit. That era ended in conflict and reset. Today, the anchors are gone, and the debt is far larger. Some analysts believe another reset is inevitable, not necessarily through war, but through policy redesign. They predict new global agreements, new currencies, or coordinated inflation to shrink real debt. Others think the system will simply stretch further, surviving through adaptation. Both views might be right, because the system doesn't need to collapse in one day. It can dissolve slowly through purchasing power erosion, through rising inequality, through quiet loss of confidence. If you're watching this, ask yourself, how much of your wealth exists only as numbers on a screen? How much of it depends on interest rates you don't control, or market confidence you can't predict? The answer tells you how tied you are to this machine. Understanding the structure is the first step toward navigating it. Remember, the system rewards proximity. The closer you are to the source of credit, the more you gain. That means thinking strategically about where you earn, where you invest, and how you store value. Real assets, skills, land, productive ownership matter more than paper claims. The rules won't change overnight, but knowing them changes how you move within them. The story of America's financial takeover isn't one of villains and heroes. It's a story of evolution. Each generation solved the problems of its time by expanding credit. Each solution planted the seeds of the next crisis. And now, after a century of compounding promises, the weight has shifted from governments to central banks, from citizens to markets, from value to valuation. The day money won wasn't about conquest. It was about surrender. The moment nations decided it was easier to print than to produce, easier to borrow than to balance, easier to manage perception than reality. That's how banks took over, not by force, but by offering a solution everyone wanted. If you stayed with me this far, I'd like to hear from you. Do you think this system can keep running forever? Or do you see an end coming? Drop your thoughts below. And if you want to understand how ancient money laws still shape wealth and power today,